Welcome to Markets Today. I'm your host, Bithe Mwema. I will be taking you through the activity on the Nairobi Securities Exchange, as well as giving you an overview of the key corporate headlines that will be driving sentiment in the stock exchange for the remainder of the week. Later on in the show, we will be joined by Kwame Owino via video call, and Kwame will just be helping us understand where the government finances today and what does this imply, or actually what will be the implications of some of the deficits that we are seeing from government operations on key investment decisions. That's a conversation that we will have later on. But for now, a highlight of what was happening yesterday on the Securities Exchange. Turnover was up 118% over the day to close at 1.6 billion shillings. This turnover was largely driven by foreigners, who made up 54% of purchases, while there were 64% of sales over the day. The top gainers were led by Kenya Airways, which was up 8.65% to 1.13 shillings per share. A lot of speculative activity there, with investors buying on the low and selling on the high as at yesterday. We also saw a bit of upward price movements on some of the banking stocks. KCB was up 8.3%, while equity was up 5.4%. In terms of market turnover, Safaricom and the banking stocks were actually the majority of the stocks that were traded. We saw Safaricom trade 13 million shares at about 30.5 shillings per share. Equity was another large mover, trading about 12.85 million shares over the day at between 41 to 43 shillings per share. KCB 4.72 million shares were traded at a price of 41.95. So a lot of excitement there, and looks like the sentiment is finally tapering off as the investors, both local and foreign, get a grip of the impact of COVID-19, and now they've actually been taking advantage of the correction that we saw through, which started in February through into the month of March, and now is more or less stabilizing. In other corporate news, we did see the Central Bank of Kenya come into the market yesterday and communicate the results of the 5-year bond, where it was looking to raise 50 billion shillings for government operations. The central bank received bids worth 34 billion and only accepted 20 billion of the bids that were put in. The average yield, or rather the coupon for this bids was 11.788%. That's 11.8% for 5-year money. That's what the government was willing to pay as at yesterday. In other news, IMF has accepted, or rather has approved, an extension of credit to the Kenyan government to the tune of 739 million. This is through the RAPID program that IMF offers to countries to be able to access funds to mitigate what is happening in as far as COVID is concerned. IMF approved funds to Kenya, Uganda, and to Zambia yesterday. And earlier in the week, we had seen an approval extended to Nigeria of 3.4 billion shillings. Now, the extension to Nigeria came with some strings attached, with a lot of wording in as far as the currency was concerned. And this is a country that has gone through a devaluation of the currency in March, and there's a strong push to actually have a unified currency in a country that operates with 2 currency points for the different markets, both internal and external. I'm not too sure what this means for Kenya as we're getting money, whether there will be an expectation to actually let the market forces rein in on the currency. Now, we are speaking to Kwame Owino, and Kwame, welcome to the show.
Thank you very much.
A lot of things are happening in as far as COVID, and we have seen you out there just speaking to what is happening and what your thoughts are. Perhaps you can just quickly and briefly just take us through, what does COVID mean for government operations? What does it mean for the investment case for Kenya? And then we can delve into other questions as we go along.
Okay. Well, first, let's start with the fact that at the beginning of the year, there was an expectation that obviously we had some crisis to deal with. One of those was, of course, we had locusts, and there was the fear that we might have a bad season for planting, but the rains came in, and they came quite early. So those were the only risks that had been factored into the into the macroeconomic picture. And then COVID comes in. I think people didn't know how serious it would be, and it's now serious. It's clear now that it's going to be serious. So obviously, it affected both sides of government spending. Government needs to spend more, but revenues will fall by virtue of the fact that government needed to switch off the economy, for instance, by asking people not to go to work and curtailing economic activity. So that affects government revenues. And if you remember, what that means is that the deficit is going to go going to climb just at the same time that revenues are falling and government needs to spend much, much more. So that's a big thing. So the next budget season, the next financial year starting in June, or rather in July, will be against a backdrop of low revenues for public sector, while government needs to do much, much more. So obviously it's going to widen the deficit. And our deficit last year was close to 6%. There's a possibility that it will go over 10% for this year, which is substantial, really, really tough. Yeah. We've also seen, corporations, of course, not out of choice, having to actually either furlough or actually keep people on staff at either keep staff or cut their salaries, or in some cases actually have to let staff go. All those, of course, have implications for what our collections are. And most of government collections, revenue collected by the revenue to service, comes from income taxes, corporation taxes on one side, and labor taxes. So if you put all these together, it's clear that it's going to be a pretty tough year, and the next budget will require very, very careful execution to ensure that growth doesn't even fall much more. Because the central bank obviously has revised twice what the growth prospects are. There's an expectation that we'd have about 6% of growth. It's right down about one third of that, about 2.3. So all those have implications for revenues. They have also implications for growth of private sector, but also public welfare and incomes generally.
Okay, so it looks like a lot, it's going to get slightly worse as we get into the next couple of years. But then there's this year that ends in June, and the revenue numbers that we have seen so far are 1.1 trillion against a budget expenditure rate of 3.2 trillion. Maybe you can walk us through that and also help us understand, as we start the next year in July, that's the year 2020, 2021, for the other year, 2021 and 2022, we're getting into an election cycle. So does this mean like maybe for the next 3 years, 5 years, we expect more volatility? What should we be looking out for if you're an investor in this country for the medium term?
Okay, let's just start with what we know as certain. So because of the necessity and the perversity, the great health danger. So this started as COVID-19, and the emergency started as a health crisis. It's become a full-blown economic crisis. And this is one that actually goes beyond just Kenya. It's global. So obviously it's thought that for many, many countries this year is going to actually be, we might see global contraction. In Kenya's case, there are two scenarios. Either we'll be able to maintain and go at about 2%, or there's the possibility that we'll have 1% growth, which are the worst scenarios. But I think what's clear to us at the IEA is that this quarter, the quarter between April to June, is more or less like a lost quarter, because it's just basically about trying to make sure that the bottom does not fall. But I think growth prospects and general government revenues are going to be really, really poor. The reason it's also bad is because according to the budgets last year, to the estimates last year, there was the expectation that the revenue service would collect close to 1.8, 1.9. It was revised back to 1.7. And we have one quarter remaining with this crash taking place at this time, and there's a gap of about 500 to 600 billion that's to be collected. It's very clear that it's not going to happen. So government is going to cross the year. Public finances are going to cross the year with even bigger deficits, and obviously some spending is also going to have to be cut. So some development spending is going to suffer. So that's one. Now on the business side, it depends on how this quarter is managed. Even if it's a lost quarter, if the illness or we are able to control the spread and there's no surge, which does not cause significant health shocks, which then in turn affects companies and people are able to get back to work quickly, global supply lines, if they open up in such a way that allows for inputs to come in and exports to go out, then it's possible for some growth to occur and then to be consolidated in the final quarter of this calendar year. If those don't happen, and so we have a longer slump, which takes place for a very, very long time, as is suggested for North America and some places in Asia and even in Europe, then obviously it's going to be much, much worse. And what that means is that we might be locked in perhaps a year of just optimal growth. I mean, Kenya could manage 1 or 2, but basically what this country needs is actually growth at 6% and above to do that. Because if you look at the buoyancy, which is the how much growth you need for revenues to grow, it's actually substantial. So every 1% growth in revenue, or rather in GDP, creates new revenue by virtue of the fact that economic activity is expanded. If it grows and falls this year, then obviously that creates even bigger deficits. And Kenya had its own problem with deficits, if you remember. And we also had a problem with big debt that we needed to pay. So all those rolled together show that, yes, it's going to be a difficult moment. I mean, some sectors might do much better than others, but if you talk about transport, for instance, and aviation, it's a really, really tough one, especially for the passenger aviation, because it's clear for most of this year that industry is going to be in a big slump.
So what sectors do you think will do better? Not necessarily outperform prior periods, but at least be in the realm of positive growth in the medium term. Are there some sectors that jump out for you? Are there opportunities that jump out for you from where you sit?
Yes, I think sectors such as, let's start with the sectors that might be in a little bit more trouble. So the hospitality services, as we call them in Kenya, but mostly tourism and specifically hotels, might have problems because getting guests and people to travel in this time is going to be really, really difficult. So that's fine. And you can see that from the fact that leading hotel chains in Kenya have actually closed very many of their establishments, and they're prepared to tough it through the season that they've closed because they won't see any revenues. So obviously that's one. I think the other sector that's probably going to have a difficult problem that's had a bit of a difficult problem as well is transport. Whether aviation or domestically, with social distancing and everything else, your costs are going to rise, and therefore their revenues will be. Now, I had expected initially that Kenya's telecommunications sector would do really, really well given the circumstances, and they have. But they are cutting their own feet with very, very pathetic service provision for internet. So we have internet services with 2 different corporations, for instance, the leading ones in our office, and the service is pathetic. You can't run meetings for an hour without something tripping here and there. So maybe this would be an opportunity for them to do well in terms of building those systems and making them more robust. But I think if things stay as they are, they'll have a very bad consumer backlash because the quality of internet services in Kenya is just pathetic, the truth be said. And our costs are actually high because we did a comparison with peers in South Africa and in India. And I think for what you pay for broadband in Kenya, you're suddenly overpaying, and the quality of the service is just, C- or D grade. So those are industries that would have had an opportunity for this to scale up. But I think they're too comfortable because probably they have revenue so easily and they don't have sufficient competition. And because of that, they might do. The other would just be food and retail. Retail in the sense of people are staying at home, of course. In spite of that and the shock to incomes, still people will need to buy food. And if they buy food, even if we have the lockdown again and again, I think government will have to reopen over time for people to deliver. That will happen. I think the other businesses that will do well is actually those who do online, deliveries and that kind of retail service that delivers to doors. This is a huge opportunity for them to expand as well. And we hope that as you can see as well, if the internet stays steady and power is available as well, then it provides the complementary goods which allows them to do well. So yes, some sectors will do well. I'm not too sure about banking because again, banking and finance, it's a very diverse group of institutions. Some will respond very, very quickly to introduce new products. Some may decide to try and keep their traditional products thinking this season will pass. So it's a mixed bag.
Interesting. Maybe I can just ask you one other question on the banking sector. We are seeing a lot of push to restructure loans. We've seen Standard Chartered, we've seen ABSA come out and say they have restructured the books. When they restructure, what's the impact that we need to be looking out for in their numbers? Does this affect their profitability? What does it really mean when they say they're restructuring?
If you restructure, then what that means is basically you ask your clients and you construct a new agreement, you revise your contract to give them, you stretch the tenure of the loan, for instance, right? Or reduce you can stretch the tenure of the loan, or you can reduce the amount of the regular payment. So say, for instance, if somebody was paying X shillings, you can say how much based on your income can you pay now, and you can cut it by half and then increase the loan term so that it's easy for both parties, but at least for the revenues to keep coming. In some cases, businesses are completely unable to. Then what it means is that you might actually just have to give them a moratorium, say for 3 months, right? And that would probably is the kind of thing that would happen with big mortgage companies or people who have mortgages and they've suffered a shock in their income. So obviously that's the kind. You'll see that in the immediate income of these banks or financial institutions, but in some cases you actually just see defaults. Because I know that there's a moratorium period, but some people will be, even with that moratorium, it's possible that when the 3 months or 4 months passes by, this person has not regained a job, then you'll see that. You're also seeing in the newspapers, many more houses available for sale, and you can tell that even as they're available for sale, not many people are prepared to bid at this time, telling you two things, that there's pressure on both the supply and demand side. So I mean, those are some of the things you might see. I think the fees that banks earn for some of these products might also go down. So for instance, you've sold government, say, or rather an agreement reached between the telecommunications company on one side and government to reduce the costs of money transfer services. So that might affect the income that was coming from money transfer services because it will be huge volume, but it might show up elsewhere. So yes, you see, I think balance sheet changes that reflect those shifts.
Okay, thank you for that. Let's look at the government's expenditure lines in as far as debt is concerned. What is happening there? What are some of the decisions we expect to see in a bid to mitigate this? Because you've given us an overview of the fact that this deficit could go to 10%, if not more. What happens if the government cannot raise sufficient revenue to meet its debt? And what are its current debt obligations on an annual basis? The principal amount vis-a-vis the interest.
Okay. So let's remember that yesterday in the evening, it's both good news, but it's also, I think, one that is you need to reflect. The IMF released a statement stating that there's been an agreement, right? And the board has actually approved a $750 million loan to Kenya, which comes down to about 775 billion Kenya shillings, which will be available for Kenya to deal with the emergency of COVID. Now, this is it's a loan, it's not a grant, of course. So being a loan, obviously, what that means is that debt to GDP ratios for Kenya has actually risen. So at the last time, I think it was just slightly above 60%. In our calculation at the IEA, some of the numbers that the Treasury gives are correct, but they're a bit dated. So if you update your numbers, then they tend to show a little higher. So it means we've definitely gone above that. And you remember that I think a couple of days back in Parliament, there was a debate about stretching the debt ceiling, which was also stretched again to allow for this to happen. So we're already that level. So yes, the level of indebtedness has actually increased. The good thing about this is it buys government a little space because they needed some space. And this debt is also not a short-term debt. I mean, there's some time to recover it. I think it's a 3-5 year period cycle. Based on the statement I saw, I haven't seen the agreement, but I saw the statement itself. So that means that government has some time to reorganize its finances, and obviously this would be useful to actually continue to so the tightness ends for a while. But 75 billion is not a lot. If you consider that tax collections are usually between 4 or 5 billion per month, right? So 75 billion is 15 days worth of revenue collections. But it's important. I mean, in the sense that it helps to ease many things, and there's flexibility about it, how it can be used. It also came with very, very tight conditions for monitoring. So the IMF actually stated in that statement, I think they understand, that they will audit specifically that amount, suggesting that obviously the credibility of the Kenyan government, even at the time when its debt is at the highest, is very low. So it's global partners themselves, such as the IMF, just basically explicitly saying that we will be auditing this. So that's the money side. So in a way, the Treasury has a little more relief than it had last week. And it's a good thing that this has been concluded. The big problem, however, was that last year, total debt payments were about between 600 to 800 billion, which is both principal sum and the amount of money that's related to principal sums plus the interest. This year, it is going to get to about $1 trillion. So I think some of these relief and the possibility of negotiating for stretching the tenure would have brought it down. But still, our estimate is the government will still be spending about 600-700 billion shillings, it's close to 600-700 billion shillings, just redeeming debt plus its interest. No wonder we have this issue about the pension services, or rather government trying to go to pensions, to retirement benefits to actually defer the payment of interest, which is a very, very dangerous thing, because it tells you nothing but that the government has defaulted. I also think that it's not legal, but maybe that's a question we'll discuss later.
Okay, I mean, you've actually preempted my question, because now we are in a space where the RBA, the Treasury, they're all coming out and saying, let us defer the interest payments that at least we're making to domestic debt holders. And my concern is, if this happens, yes, it gives the government relief, but it does set precedents for what could happen later on. But more importantly, if I am an investor in government debt, either through the money market or directly through T-bills or the T-bond auctions, what does this mean for me, especially for the money market funds? If I've been getting a return of 10% or 8%, depending on who your manager is, if the government differs for the short term and maybe extends that period of deferment, what happens to my investment ethos, which has been, okay, flight to safety, let's put it in the government bonds? It really is a bit of a, I can't reconcile now what that means for me as an investor. Maybe you can help me understand what my considerations and my thought process should be.
Okay, let's just start with the question of the law, right? We have the Retirement Benefits Act, we have people's rights under the Constitution, and remember that in Kenya, there is no obligation for an employer to set up a provident fund or a pensions fund for employees. It's usually voluntary and a negotiation. So it's a contractual obligation. Then this employer together they have to be trustees who then find a manager to manage the money. So it's a contractual obligation. So like we in the Institute of Economic Affairs have a small provident fund, there is no way our provident fund will be negotiating with the government to defer payments that are due to us on our own private investments without our authorization. So it's just out. And if they do that, they'll be sued. They're going to be sued, and very quickly. So that's the first. Second, the Retirement Benefits Authority has to be very, very careful, because one of the things it's supposed to do is it's supposed to be independent and to provide. Now, to go out there and hammer a political deal with the Treasury based on Treasury's distress about payments without consultation, and in a way that actually violates their standing as an independent arbiter, as an independent regulator, would be very dangerous for this institution, and tells you something about the integrity of people who run it, because that calls their integrity to question right away. And I speak about this as not only a person who understands this law. I've been a trustee in the pension fund for the Institute of Economic Affairs, but because our colleagues are asking, how can the Retirement Benefits Authority, whom we rely upon sometimes to even protect us against the excesses of government, actually coming here and hammering a deal without that? So whatever it is might be, and the pressures are real, they really need to be careful. Now, the third point is, yes, as an investor, it's going to damage the pensions industry, because we then know that your income or your investments are not safe because people can hammer a deal out there. So every investor is saying, fine, what does that mean? We might suspend our payments this year to look at what happens again, because once government, as you said, there's a moral hazard. Once government has started to use pension funds as an easy sink for covering its fiscal indiscipline, it will happen again and again and again. So definitely, this could be a death blow to pensions, which has already suffered in many, many other places, because there are no alternative ways for actually making these arrangements. And it will be a real, real danger for this to happen. So I just hope that when I first heard about this, I thought it was just the usual rumors. It is not. It looks like some people are actually very serious about it. If this isn't handled very well, starting just with myself, people will have to reconsider whether pensions, and the industry hasn't been, some of its returns are not necessarily some of the best, but people actually think about it. We have the alternative with the National Hospital, with the National Social Security Fund, has its own advantages. The pensions industry, especially the private side, was the only hope that people had. And here we are making a very dangerous and reckless move that could damage it without repair.
I certainly share your sentiments, and perhaps I think there's also then an extension to money market funds, because typically if you're investing, you put money aside for your emergency, and then before you go to higher levels of investment, you say, let me put my money in a money market, but then the money market puts it in government bonds. So even that return that I have been getting, so it really, it's it's a tight spot, because then it really now changes your investment ethos, and it really just leaves you with equities, and perhaps that could explain what we're seeing we're on equities. But maybe I can come back to the equities, and we have seen a lot of things happening. I expected the market to correct downwards. Clearly, the market has proved me wrong. We have seen a lot of interest now, yesterday especially, from the foreigners, and we are seeing the prices going up. And my stand is always, these prices shouldn't be there, because COVID, which started as a health crisis, as you mentioned, and now is an economic crisis, will have a negative outturn on the financials of these companies. And when you are investing in these companies, you're really investing on the fundamentals as opposed to speculating on what could happen. When you are looking at the investment case for Kenya, and I'm sure you talk to many local and foreign investors, what are you telling them in as far as the equities market is concerned? And maybe over and above that, what are your views on currency? Because for our market, it's foreign dominated, so currency is always a key parameter when people are deciding when is a good time to come in and when is a good time to come out.
Okay, I think that any person who's investing in Kenya thinks about two things. Where is the alternative? And if you think about where to invest in, whether it's in emerging markets and all that, and in the US, the more mature markets, as some people call them, is it safer to be in Kenya now than other places? And the only thing that has concerned many of them is the ability to carry away their money, and the Kenya shilling was far too strong the last few years. So knowing that in the space of 3.5 months, we've had the Kenya shilling move from 99 to about 107, 106 yesterday, it's telling you that both the exchange risk and the market risks are probably global, but the exchange risk actually has disappeared relatively. So obviously that might explain part of that. It's easier to actually buy Kenya shillings with dollars. Then if you can find a good investment, that's first. The second is, it's clear that those who do equities markets, who work in equities markets, are not investing for tomorrow. There's definitely going to be a recovery. And even the worst case scenario shows that Kenya could actually have just a growth rate of about 1%. Now that's not bad. Other places will actually contract. So in a position in which you have the chance to actually acquire equities at a competitive price, because actually you've been favored. On the one side, they've been favored with a currency change that is favorable, then you can actually buy and bide your time, because obviously whatever happens, and COVID would be a serious loss. Or rather, will extract a serious loss from global economies, several $100 billion. But on the whole, corporations are going some corporations are definitely going to do better. So when that moment passes, those who made the decisions at this time, if they chose the right equities, will definitely be proven to have been prudent.
The option of where's the alternative, because especially when you look at Africa, Nigeria is certainly not an alternative. So we could be seeing an outpouring of funds that could have been allocated to Nigeria to Kenya, largely because of what's happening. We are coming, I think, to the tail end of this show, and we certainly appreciate your time. Perhaps you can leave us with a parting shot. How should we look at where we are at today? What are some of the trigger points we should look out for in the short to the medium term if we're making investments generally in Kenya?
Okay, let me tell your viewers that I'm not an investment advisor, I'm just a student of economics. But let me tell you what I think happens. I think if you're seeking investment, then perhaps an investment advisor is the person to go to. But let me speak about the economics, because what I see. As I said, nobody saw the shock of this happen. But I think Kenya is not... government itself sometimes, and many people actually assume that the difficulties that farms are facing today are all on account of the COVID emergency and people getting unwell. And that's not entirely true. I think this emergency ties up in a very evil way together with the locust infestation, and yes, together with the fact that we had already a slowing economy. If you looked at it from last year to this year, in the number of jobs created in the formal sector, for instance, was actually just half of what was created in 2014 and 2015. So basically something was happening. While the economy was growing, GDP was growing, but it wasn't feeding all back into small and micro-sized farms, and even large farms actually have been shrinking quite a bit over the time. So we had fundamental problems even before this shock came. And so when this shock came, that convergence is what will lead us. And that's why I think that it's going to be, the central bank governor said it himself, that it's going to be a V-shaped recovery, which means basically it's a shock as soon as the infestation is the COVID is controlled, then we'll be having a recovery. I think we have lost. I mean, we were on a trajectory of 6%. We are right now on a trajectory of just about 2. So if we go to 3, it means that 3 percentage points would still be lost. So obviously that's a loss, and that's not going to be recovered unless government works very, very quickly towards the end of this year. So what it requires is, this is not the moment to waste cash, whether in private homes or basically out there. If you can make investments, it would be good to lock them up in a fine investment with good advice. But on the whole, I think it's going to be a little bit tough. As I saw as well, there's anticipation that we will not have enough food, especially grain stocks. And so we've opened opportunity for more imports. Not a bad thing on the whole. If food is available cheaply, I think that would also help. But my thinking is that if we can go through this rainy season, have some decent harvest with the locusts controlled, then we'll be able to bounce back much sooner, as is definitely what the desirable scenario should be.
Okay, so maybe your final thoughts on inflation, because you bring out the context of food. Maybe some thoughts on inflation and interest rates and the outlook for that. Okay,
I think yes. I think the positive thing about this moment, to be honest, is that fuel prices are very low in relative terms, right? Fuel prices are quite low, and fuel and food tend to be drivers of inflation in Kenya. So with fuel on this other side still low because of global demand, I mean, demand is not that high, and we import our fuel, so that helps us, because otherwise it would have driven inflation even higher. I think we'll have to watch for the next quarter to see what the food situation is. If harvest comes, because this is the moment when the harvest will come, though we hear there are floods, which is not a good thing, it's telling us that we're going to have less food than is ideal. And I hope what that does, especially for grains, rice, maize, and wheat, is it tends to bump up the prices of food. So let's watch about sugar as well, what these 4 products together. If the prices begin to go up because of obviously domestic supply is not sufficient, then obviously it will roll to inflation, which is also undesirable. I hope government as well maintains a good discipline, so that obviously some moves that it makes does not lead to inflation from that money side. But on the whole, I think that
Thank you so much for your time, Kwame. We really appreciate, and we hope once all of this is over, we could be able to have the privilege of having you with us to help us shape our thinking as far as the macroeconomy is concerned. Ladies and gentlemen, that was an overview of what the government finances look like and what this could portend for investments. As we have said, rather I have said, and everybody else on this session has said, it's just a matter of holding on to cash, because you need cash, and cash is king in this time of uncertainty, so that when there are opportunities that arise in investments, you can be able to allocate your funds appropriately. Thank you for joining us, and good day. See you next time, same time. Good afternoon.